Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about we're going to go about 15-20 minutes today. That's about it. We're going to look at a couple of trades that we did last week because I was not able to host Options Guide TV on Friday. So we're going to come back and look at those trades, and then we'll worry about setting up some new trades going in on this upcoming Wednesday show. Easy for me to say. Right now we're getting to the tail end of earnings. There's still quite a few companies that are announcing, but a lot of the Mag 7 have announced. Your opportunity to buy NVIDIA at below 100 has now passed. NVIDIA is back up again, so there was an opportunity to buy the dip. You can still buy the dip. But we're still somewhere. We're still a little bit south of where NVIDIA was after the stock split. So I find that interesting. Jobs data is a big deal. A lot of people are saying the Fed screwed up by not lowering interest rates. The last meeting that they had a chance to do it by cutting all the central banks, or you should not necessarily the central, all the banks across the world were cutting, including Canada. Europe had already cut, and the Fed decided not to. The very next day, they got some bad, at the end of the week, they got some bad jobs data. And so now we're looking at a high probability of a 50% rate cut in September, but definitely 100% probability of at least a 25 basis points rate cut for sure. So the markets are going through trials and tribulations. We're not even into September and October. And, I think that the seasonality of the market is real. September and October are always the more volatile months. They're the months that underperform year in and year out. So being in the middle of August, looking into September and October coming up, I'm not too excited about the marketplace. Want to get the election over with. Once that happens, I do think I want to be bullish on the market. I'm not necessarily saying it matters if the Democrats or the Republicans win. I just think that unknown event needs to go away. And I do think that the market does have some resiliency here, and there's going to be some opportunities going forward. That's my outlook for the end of the year. Okay, so let's look at what happened with Lilly. We put on a real good trade in Lilly. We also talked about when we put the trade on that we would have did it. Well, let's just look at the trade. Let's set it all up. Lilly has been strong. So let's go to the to the Tradier Pro software. And Lilly has been strong. We're looking at 892, real strong marketplace. What we had happen in the underlying stock is that it opened up about the expected move. We set up a butterfly that would be benefit if it would move a 1 standard deviation move. And it opened up the expected move and then moved to the 1 standard deviation move. And there were many opportunities to get out on the day of earnings. If you stuck around, though, then you might have had some issues because the stock just kept on going. And so there is always a rule of thumb with skip strike butterflies. If it does hit your short strike, always consider just getting out of the trade. And that's always the way that I'm going to look at that trade. We're bringing in a net credit to the account. So if the market goes down, we're profitable. If the market kind of goes nowhere, we're profitable. Goes up a little bit, we're profitable. Goes up a lot, we're profitable. As long as it just doesn't blow the market away and do double the expected move, we're going to be okay with the trade. So you're not looking necessarily to try to get a home run on these trades all the time because the probability of success is so high with the trade. Just want to try to make sure you don't get blindsided by it. Okay, so here's the trade that we did. I'm going to grab the graphic and pull it over here. So 1 second, because I wasn't able to host on the Friday show. The market was at 775. We went and bought. So the market's all the way down here. So this is the Tradier Pro. I should probably introduce this. This is the Tradier Pro what if calculator. We did a skip strike butterfly, which means that we skipped this strike on a standard butterfly. And that created a trade a butterfly that we could get done for a net credit to the account. But it added risk above around 855. Well, actually, if you want to know where the maximum risk is, you just look at the strikes. So the strike was 862.50. That's where the strike is at. From that point on up, we had substantial risk, right? We embedded a credit spread inside our butterfly to help pay for it. And because of that, our maximum risk of the trade was going to be $750 or $750 less whatever net credit that we received on the trade. Well, the market opened somewhere in this range when it happened, and then drifted up this way, and then hung out a lot in this area. So let's go back and look at the charts. They announced on a Thursday, and I did mention that. So let's pull this up, and there we are. We're still right back to where we started. And we're going to look at the chart in Lilly. So they announced on a Thursday, but it was before the open. And I do talk a lot about, if you're looking at butterflies on high price stocks around earnings, it's always nice to have 1 day to trade. The only downside about that is you have to be right in that 1 day. But here's where the market opened at, obviously, after earnings. They had a big down day the day before, thanks to their competitors that had some perceived as bad earnings news. And here is the day that they announced earnings. And here's the high got up to 875. The close was closer to the 824. Like I said, it closed somewhere close. That was about the expected move. And then it traded somewhere in this range during that period. Okay. Then the very next day, which that's the range that we kind of wanted it to stay in, right? So then the very next day, it actually closed on the high end of the scale with that trade. So Thursday, Friday, and then now it's came, well, I guess it's still up a little bit today as we look at it. It's at 893. So it's still about 890. So when you're in this range right here and you drift on up, if you came anywhere close to that short strike, you should have got out of the trade. Should have been able to put it on for a net credit, take it off for some sort of net credit to the account. Might have been only 50 cents. You received 50 cents for putting on the trade. I think the number was actually 45 cents, but you should have been able to get this off for somewhere close to that amount, especially if you look somewhere closer with the red air candle, somewhere in this range at the 840 level, 846, 847 level. So a good trade overall. Marketplace then takes off after that, and Lilly's on its way again. This is one of the stocks that we actually had in our deep in the money call portfolio. Sad that it actually took a downturn, but we actually adjusted it in that portfolio by rolling the calls up and out in strike and going back from a 1 delta, from a deep in the money option contract back to an 80 delta. All right, so now the only other trade that I want to review today, and like I said, we're going to be short and sweet here on Options Guy TV, is the VIX index. We got lucky on a VIX trade. We put it together. We put on a butterfly that was profitable on the downside and had a very short-term expiration. 1 second, let me grab a little bit of water. Had a very short-term expiration on it, and it just panned out. The market actually came down and settled right near our short strike of our butterfly. And now we put on another butterfly. So we came back and did a rinse and repeat. And this is the exact opposite of the butterfly that we did on the first I should say the exact opposite of the butterfly that we did on Lilly. Lilly, we skipped a strike to try to create a credit here, and we can move out a little bit here. Here, we actually on the long side of things, on the protection side of our butterfly, we actually did it shorter. It added more of a net debit, but created a situation. This is the zero line on the what if calculator, that if the market did go down, that we would be profitable on the trade. So as long as the VIX didn't continue on up, this trade was profitable. And if it landed right around 22 was actually our middle strike on this trade. So right in that range. So this was actually a home run too. It came in on Friday. Let's go back and look at let's zoom out a little bit here. And let's do the little dance, because I'm going to have to change the VIX graph. Okay, so give me a couple more seconds. Let me get the actual VIX chart up and get zoomed in. All right, so here is where the VIX closed on Friday, 8-7. No, on Friday was, I'm sorry, on Friday the 9th. On Wednesday the 7th, it closed right here. Here's where we're at. This would have been determined on the open. So on this day, we had the VIX range between 21 and 29. So on the previous close, we closed on the downside somewhere around 24. So that was very close to being in the range. So then we want to look at VRO, and it shows that on that Wednesday, this would have been the settlement price of 22.88. So even though you see this on the charts, this was the close the day before, the last day to trade the options. This was the close where it actually opened. It ended up closing at the end of the day at closer to its high, 29, but it got down. So it closed very close. Wow. Settlement was, and I didn't look at this obviously before I came on, but the settlement was right around 22.08. So at the very bottom end of this channel. And the VRO is the actual settlement price for the VIX. So that's only going to update on Wednesdays. And that's when that is determined. And so they look at the opening prices of all the SPX options on Wednesday, and they determine where that settlement price is at. And so we had two trades that landed inside the wings of our butterfly on the settlement day. You might have got out the day before, but I don't mind riding the VIX options to the very end. You can close them. Overnight risk is huge, obviously, and I wish that they would just settle on the close on Wednesday, but that's not the way the VIX are. They're a little bit old school in that you stop trading on Thursday and the settlement price is determined on Wednesday morning. So, like I said, it's going to be short and sweet. I'm still trying to get back a little bit from a rough weekend. Had a little bit of sickness over the weekend. So with that mentioned, if you have any questions or you have any comments, please do put them in the chat box. And if not, we'll be back with a full-fledged Options Guide TV on Wednesday at 11 a.m. Eastern Time inside the Tradier Hub. Please stop in. Thanks for stopping by.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.